Hey, the stock market got you down, giving you the blues, a little anxiety right now. You're not alone. A lot of people are feeling it, all the volatility going on. We're gonna talk today about 3 things that all of us can do to help insulate your portfolio so the worst case scenario that you might be thinking of doesn't happen to you. Today on Mindset with Brad Barrett. Let's go. Welcome everybody to Mindset. I am Brad Barrett. This is producer Jarrett, and we have someone to introduce you today. Kira.
Hello.
Say hi to everybody. We're growing the team here. We're very excited to have Kira. She's been, you guys have been seeing our behind the scenes, our social media, and we're gonna have her on the show. We're gonna talk about some fun stuff because she knows a ton about finance.
Wrong.
We're gonna go through it together. Hey, we have a fun one today. We're gonna talk about market crashes. Look, obviously I've been hearing a lot about it as an advisor with my clients, what we've been seeing over the past couple weeks and months since the tariffs. We're gonna talk particularly about crashes, but really we're gonna talk about what you should be doing, not just like right now during a crash or maybe even after a crash happened, but also to prevent a portfolio and your risk losses in future crashes. Because let me just tell you something, it's probably gonna happen again.
Like I feel like if you're prepared and have these steps that we're gonna talk about,
Yeah.
you won't have that anxiety and fear when all the news and everybody's talking about the crash is coming.
That's the goal. That's our goal today, is to kind of walk you through some steps that we would see from a financial advising perspective to help prepare your portfolio and you, to Jared's point, for future market corrections and crashes.
The mindset.
The mindset.
It's what the Japanese call unagi.
All right, but before we start on this one, I thought it'd be good to define a stock market crash. You guys heard that word before?
Yeah.
Okay. So
It's bad.
So we think bad.
Feel bad.
It's like a bad adjective.
Yeah.
Okay. So a crash, it's a sudden sharp decline. Makes sense, right? Crash is boom, you're literally going down. We saw that in the first week after Trump was in the Rose Garden, talking all fancy, holding up the board, and Now what happens with a crash is there's a couple like phases to it, right? You first have this initial shock. Then you get into this period, and the period can be a week, a day, a month, a quarter, a year. I mean, there's no definition of time period here. But you get into this period of intense selling and volatility. So you kind of start with a crash of the initial descent. Then you have like this panic selling.
People jumping off.
Just
selling,
gnarly, right?
Time to abandon ship.
And then the last phase of a crash in particular, if you want to call it that, is more this bottoming formation. Now there's a model that I've discussed before, and I won't go into details on. I'm going to bore you guys on Kira's first show. She's going to be like, what are these guys talking about?
I'm learning a lot.
See? So the capital asset pricing model is something that we learned fundamentally that I always love. There's multiple things you can look at, like price to earnings, things like that. But the capital asset...
I'm bored already.
Okay, look, just bear with me, okay? This is important, okay?
Okay. Nerd stuff.
Got it.
Nerds.
It's the capital asset pricing model involves the 10-year note, which is really interesting because that's kind of the bond market, how things run. So what I'm trying to say here is this.
I don't know what the 10-year note is. Like, I'll be real. Is that something people all people should know?
We need to talk off camera.
Probably.
Okay. We're gonna roll bypass that one.
Is that like something you find online?
You know, can you look up the actual definition of the
got it.
10-year note? I wasn't trying to like poke fun. I was trying to like use it as like a...
You're a real moron, Jared.
What an idiot! Oh, what a loser!
I've always felt smart on the show until today.
Until just now.
Just now.
No, that's not what I meant. No shame.
No shame.
No shade.
A 10-year treasury note is a debt security issued by the U.S. government that matures in 10 years and pays interest semi-annually.
What Kira just read is the right definition, but let me just describe it to you. We know this is kind of the risk-free rate. It's the proxy that most investment managers, most banks use, like, hey, what's the savings rate? What's the money market rate? They're gonna typically go on the 10-year note and roughly around that. That's a loose, not as eloquent as Kira read, but a loose way to describe it.
Okay. I mean,
I love that.
that doesn't help.
It's okay. What I'm trying to get at, it tells us it's a really good indicator if things are overvalued or undervalued. And I'll be honest with you, the capital asset pricing model has been showing over the past year that it's been overvalued. And what I mean by what it is, the stock market, the S&P 500 in general, the broader index, has been overvalued. So this is, to us, a lot of this is more like a correctionable time period, although it happened suddenly right after tariffs, which is, again, one of the things that you see in market crashes or economic cycles. The first thing that comes around is speculation, and there's usually some geopolitical or political event that's happening. And that's what we're seeing. quite frankly. So the thesis of this show is making sure that you feel prepared and are not like pulling your hair out, literally, during times like this. But to do so, I think a lot of times context is everything. And a brief history of US crashes and understanding that this is not the first time, I think is really important. The first panic was 1837. The cause of it was speculation, bank failures at the time. The one we most notably know of, 1929. Have you heard of that? Did you ever study that one? I'm curious to the younger generation.
Great Depression.
Yeah.
That's that. Okay. Yeah.
Okay.
Yeah.
Okay.
I mean, that's a big one. When we think crash, even for
Correct.
everyone has to think the crash because it set off one of the worst periods in U.S. history.
Exactly. The stock market lost 90%.
Whoa.
90.
It's a lot.
It's a lot.
Those kind of losses, you can understand why. I mean, not to be too dark, but people were literally jumping out of buildings.
It was
because fortunes were gone.
It was gnarly.
Yeah.
Through that period, there was actually a recession in 37 and 38. After 54, you had the Kennedy slide.
It's a dance move, I assume.
Nope.
Oh, give us a demonstration.
The electric slide. Yeah. But it was actually a flash crash. The Dow lost at that time 5.7% in a single day. That's a crash. We saw that a couple weeks ago as well.
I mean, it's still 90%, but I'm
but,
assuming 5 is a lot.
But remember, a crash is defined, like we talked about, as the initial shock, panic selling, like those phases, right? Then you get into then that's when it kind of starts phasing out the bottom and gets into a correction.
Well, that brings up a question. What's a typical, if I'm seeing 5% as a crash,
yeah,
and I know that S&P or whatever the market goes up and down daily, what's kind of the average fluctuation of the market? So if like a 1% is big or like point, I don't know what that.
That's a good question. We have to look up the average. I don't know that it's a defined number. I think people would define it differently. If you lined up 10 people, they would say, well, 3% is a pretty big day. Well, 1% is a big day, right?
They're saying that it's about 1% up and down is a typical
per day.
Yeah.
Yeah, so that's the average.
Yeah.
Back to a couple of the historical ones. The 73 oil crisis bear market. You had Black Monday, that one crazy day in October of 87.
I've heard stories, pretty gnarly.
Yep. Then you had Friday the 13th, which was a stock market day in 89. 08, the financial crisis, the Great Recession. 2010, there's a bit of a flash crash. And obviously you have the pandemic in 2020. The summation of all this is just understanding that the one thing that we can all understand and agree upon is that there's going to be some uncertainty in this world. Markets just don't do this all the time. Did I do that right? Let's go this way. Which way's up?
For our lovely audience?
For our audience.
That way.
So this way?
Yes.
Yeah.
Okay, there you go. Anyways, markets don't just always go up. Take a look at this graph right here. You can see over time that you're going to get a trajectory going upwards. And I think it's important for you to see this, and likely you've seen a graph like this before. Talk with your advisor about it. But the history of the market tends to trend upward, but not without its ups and downs. All right, so we walked through some crashes, some notable ones, obviously. Let's talk about what you can be doing now and for future crashes or corrections in your portfolio. The first one, and look, don't roll your eyes at me, just bear with me. Diversification. Look,
we've heard this a lot.
A lot. I know. I'm going to beat a dead horse, but look, I would argue right now that a portfolio that's diversified, and I can speak to our portfolios that we manage here at One Capital, that are largely mitigated the losses compared to what you would see directly on the S&P 500 or the Dow. Diversification does matter. I know it's boring. I get it. But diversification versus concentration is one of the key ways to help mitigate losses during crashes or corrections.
Is there a rule for like how many different investments you should have, like in 5 different places and 3 different places?
That's a good, I mean, in terms of the amount of investments or companies or sectors or industries, not necessarily. I do believe there's a point of over diversification. You spread yourself too thin.
Yeah.
So you want to be concentrated in like 5 main areas, I would say. You want capital markets, you want equity markets, both value and growth. You want fixed income. You want things that are corporate bonds, short term, maybe even municipal bonds if you're an after-tax account. You want real estate. Then you want commodities, gold, silver, oil, corn, beans.
Corn.
Coffee. Everyone loves coffee. And then you want some emerging markets or, some private equity kind of stuff, right? Those are some key areas. And then from there, you can kind of build a really diversified portfolio. But this is also where an advisor comes in to help you with this point.
Sweet.
So diversification is number 1. Number 2, dollar cost averaging. Look, buying through this market separates the men from the boys, in my opinion.
What is dollar cost averaging?
But dollar cost averaging is buying consistently throughout the year and creating different bases in the security that you're buying. So instead of buying something one time, you're consistently investing into it over time. You're literally averaging out the purchase price of your investments over time. Now, I know I might be speaking to someone here who already is retired and be like, well, Brad, I'm not contributing anymore because I'm retired. I get that, but you can still do that within your portfolio. You can do dollar cost averaging through your dividends or your fixed income coupons coming off of your bond portfolio. You can reinvest that. And the last one is knowing your actual risk, because I think it's important to know if you are over fearful, and there's a line that you would know, because if any of you out there have been through this kind of stuff before, you know, like this one's really weighing you down. You might want to really take a look at your risk in terms of what exposure you're taking to the markets, because maybe it's not the right risk. Like, I don't want you, I tell my clients, like, if you're losing sleep, like literally, I need you to call me and tell me, because that's not okay. That's unhealthy. Knowing your risk tolerance is a big key here. And speaking of risk tolerance, we have a real treat for you today. I just thought it'd be wise for us to bring in the friend of our show, my business partner and president of One Capital Management, Pat Bowen. Welcome to the show, my friend. Come on, the comment section is gonna go wild for this one. Look at that hair.
That is a cheap shot.
How are we doing, Pat?
I'm doing great. How you doing?
Good. So we're talking about risk tolerance, and look, being the architect at our firm for our discovery process for as advisors, I thought it'd be interesting for us to like have our viewers and have our subscribers who are watching this show around volatility and how, you know, all the things that are going on in the market. When we talk with a client, walk them through like how we as advisors would sit with them and help them define their risk tolerance.
That's a good question, especially where we're sitting today. And I suspect you've had a very similar experience as I have, certainly over the last 10, 15 years or so, where we've had a handful of these volatile markets, bear markets. I just like to think of them at the end of the day as opportunities. But from day one, the initial meetings we have with somebody who is a potential client, we have to start gauging their own personal tolerance for risk, tolerance to see the value of their portfolio going up, or more importantly, in this case, down. Now, we went through the dot-com bubble bursting, went through the global financial crisis, went through COVID, which was very short-lived, so it wasn't that difficult to tolerate. And then we had ourselves in 2025, well, 22, we also had a bear market, stocks and bonds. But in this year, there's no proper term yet for it, so I'm just going to throw it out, and maybe we can call this one the tariff taser. So it was kind of like getting tased, a little bit of shock to the system. You heard it first here
on Mindset. Here at One Capital, the tariff taser, I like it.
The tariff taser. So let's see if we're the first ones, and maybe it'll stick out there. But is to ask somebody the question, if they become a client now, you're in a discussion now, and let's say they're relatively new to this investing thing. How did you react if you were invested back in 2025 when we had the tariff taser, or 2022? When the stock market was down, global markets were down, bond markets were down? That one was actually very difficult to live through because there was really not much of a safe haven to hide. How did you react? Did you go to cash? Were you inclined to go to cash? Did you call your advisor every day? Or if you weren't working with one, what were you doing on your own? Were you just trying to hide? What did you do? What was your emotional breaking point where you said, I am down X? And you could start with a percent, but you got to translate it to dollars. That was as far as I could go. Well, that gives you and me a pretty good barometer of what that tolerance for risk is.
Now, with that said, one thing you said, which I totally agree with, I mean, it's good for people to kind of understand this dialogue as they're relating to their tolerance, because a lot of clients come in, we ask them about risk tolerance, and their initial reaction to us saying the word risk is, well, I don't like to lose money, right? And I'm like, well, no one does, but we also know historically there's gonna be volatility, which is what we're seeing. But you made a comment which is good, because that is a really good barometer, like you said, about what did you do in 08? What did you do in 2020 or 2022 more recently, right? But what about a younger investor, or maybe someone who wasn't involved in the markets? Maybe they're older, but they weren't involved in the markets then. What would we kind of help them with outside of that barometer to walk them through risk tolerance for their portfolio?
I think one thing you have to try to do is create a relatively real world example.
Yeah.
So let's just say it is a young person coming to you. I think you have to try to take the number they have and say, let me apply the math from the global financial crisis or the 2020 or the 2022 or even this year, earlier in the year. Let me apply the percentage math to your dollars. And if you woke up over 3 weeks' time and your portfolio went from 50,000 down to 40,000, how would you feel? So the idea when we've had that discussion with our client and we understand, I'm going to just pick a number right now, that, hey, my tolerance, if you showed me my portfolio and I woke up in a week and it was down 10%, I'm just going to use that for simple math, and that might be somebody's tolerance level. Okay, how we need to then take that, they can't really tolerate more than a -10. So what we need to do is take that, translate it into our understanding of capital markets and expected returns and expected volatility. And it's not just one thing. There's U.S. large company stocks, there's international developed markets, there's emerging markets, there's bonds, there's private assets, mixed asset classes, and putting them together. How is that mixed asset class portfolio likely to behave during a particular type of event? And if the market down 10%, we just literally have to dial in the science side of this whole thing, the engineering, to build a portfolio so that we do the best we can to give them that downside protection that doesn't violate that sort of emotional marker of 10%, or call it a guardrail. And then we build the portfolio that way. And Brad mentioned something earlier. You have to marry it with, now, is that actually at a level of return expectation that is too low for them to achieve their objectives, whatever they might be in the long run? Retirement, certain lifestyle, certain things to do, travel, philanthropy, kids, grandkids, all of these objectives, their hierarchy of objectives. And then you might have to trade off the things at the bottom of the hierarchy of objectives because you got to marry it back up to their tolerance for risk.
Yeah, I know. And I think, that this tolerance game, and I don't know if you agree with this, Pat, we've talked about it when we can design things, but when I'm talking with, especially with my younger clients in particular, like risk tolerance is always, again, don't get exact with this math, but risk tolerance is always like one half of the story. Because our job for advisors as well is to align them, okay, hey, before we get into risk tolerance, let us show you through a good holistic wealth plan what your money needs to do based on the goals you've described to us. Because it helps them almost marry, in a way, okay, I'm thinking this or I'm feeling this, the emotional side of their human nature, right? And then let's bring in the logic here, and then let's have a sound conversation about, okay, what you're feeling is not, I'm not discounting what you're feeling, but now that you see where these things need to go based on what you want to do, a lot of times I get the reaction like, oh, okay, yeah, I do want that more so than I want to freak out about a market volatility. And we are able to help them, educate them, because remember, knowledge is power, especially in this business, right? The more we get them comfortable with what it is we're doing and why we're doing it, I think their tolerance of risk becomes a little bit more acceptable. Not that we're trying to change their DNA, but like almost show them what the numbers say and then let them almost talk on that. I mean, wouldn't you say?
It's one of those things, I think of it in this way. Like, you go to the dentist, and the dentist is going to have to work on a tooth or do some filling. Now, they're going to give you this shot in your mouth with Novocaine. And they're really well trained today. Going back when I was a kid, they weren't very well trained. They just got in, jabbed it in you, and you're like, wow, that really hurt bad. I wish I knew it was coming. Now they're fantastic. They'll numb you up a little bit. They'll let you know you're going to feel this pinch. It's only going to last for 3, 4, 5 seconds. And then great. Now I'm prepared. I understand this is going to come. It's going to happen. It's just part of the process. And that's where I think advisors have this very meaningful role. Educate, understand their tolerance for risk, understand their emotion, and make it actually our own, because we're going to live it with them. And we can get them through there because we have the experience.
We're also a better experience than a dental office, so don't not go to your advisor because we said we're like a dental office.
Look, I love
I do like.
He does a great job.
No, it was good. Hey, Pat, that's awesome. I hope everyone kind of gleaned from that a little bit of how a professional wealth management firm, an advisor would sit with you to talk about tolerance. Pat, as always, thank you. It's always a joy having you on, man. We're going to have you on real soon, so everyone stay tuned for Pat Bowen, my friend. Thanks for joining us, man.
Thank you. Good seeing you.
Always good talking with Pat. If you're a younger investor, when we talk about risk, I mean, it's different for Jared and I potentially and a lot of our viewers, but how do you view risk?
Yeah, I haven't invested, so I can't really
We're going to talk about that.
tell you. Yeah.
We're going to talk about that one. We're going to get you guys set up for you and Dylan.
All right.
Okay.
Let's do it.
But when, as a younger person, when you start to hear things about like stock market crashes and, you know, all these things that we've been hearing recently,
Right.
how does that affect you? I mean, if you haven't started investing, does that affect you at all? Like, what are your thoughts when you hear that stuff?
Crash hits, same thing for you. I get scared, but I'm like, I don't really know what I'm scared of, you know?
That's a good point. I think that's actually,
Yeah.
think about it. I think people, it's almost like subliminally they're supposed to be scared.
Right.
Well, yeah,
Right?
right?
The herd mentality.
The herd mentality, it's exactly. And there's real to it, but like I have had countless calls and meetings over the past couple of weeks with our clients. And you know the common denominator, the comment I've been getting is, but Brad, this one's different. And I want to say this very candidly and honestly, the best way I know how without sounding how it might sound, is do you know how many times I've heard that in my career? Like I was around during 2008, during 2013 government shutdowns in Syria, 2015 during the summer of Brexit, right? The 2016, 2017 volatility of the election and President Trump, his first term, 2020, the global pandemic, 2022, the bear market. Like I have heard, oh, but this time is different. And the answer to that is, look, it's always going to be different, but the fundamentals and the design of how to get through it will likely always stay true and be the same.
Different but the same.
Different but the same. Ooh,
Yeah.
wise word.
Wow.
Like, just take the past 5 years. Let's just start with the global pandemic. Where were we in the global pandemic when you're like, is this really happening?
It was my senior year of high school, so that's why I don't know finance. I took economics and they were like, go home.
Go home, you don't need it.
Go home.
The world's
Oh,
ending,
okay.
go home.
The world's ending.
You don't
Don't
need this
worry about
anymore.
it.
That's, geez. Yeah, your senior year was the pandemic.
2020, yeah.
Where was your graduation then?
It was drive-through. It was the best. No one wants to sit through a high school graduation.
Oh my God.
At McDonald's, here's your
Actually,
diploma.
that's,
Here's a burger.
I'll be fair, that's true. Because my graduating class was 550, and I remember, thankfully I'm a B, and I,
Oh,
my
yeah.
parents and I, we snuck out after that. Oh my gosh. Like we all remember those, where we were and like what was going on, but think about that.
That was different, especially when you're talking about, like, I was, an adult in 2008, so I knew what was going on. No offense. But no, 2020 was like, it was more than just finance.
Yeah,
And I think, and to be fair, to me, finance was the last thing on my mind.
for most people.
Yeah.
End of the day, you saw this huge, big, deep V, but I bring that up just because this is different. Yes, 2022 was different. We had a historic rise in interest rates. We had inflation that topped out at like 9%. I mean, yes, it's always going to be different, but the things you approach and how you approach it should be somewhat the same. Hey, I enjoyed that one. I hope you guys all did as well. Again, the three things I think are really important when it comes to managing your portfolio or managing crashes or corrections is diversifying yourself, rebalancing, staying consistent and disciplined, and then really truly understanding your risk tolerance really matters. We do enjoy you guys watching today. Make sure to subscribe, share the video, comment, leave us suggestions, let us know. We always love good feedback. And until next week, I think we're talking about...
Man, you always put me on the spot. I never remember. Hey, this is a good one.
Yeah.
How to deal with the emotional ups and downs of your money. The big swings, it kind of goes into this
Totally.
crashes and ups and bigs and downs and all this stuff. It's hard to manage when you're just like the extremes of either way.
So we talked a lot about the pragmatic approach to this. This is kind of part 2 next week, so stay tuned. There's a little more of the emotional side of it because it plays on this. And as always, like, comment, subscribe. We really appreciate all of you subscribers. Hey, leave us a comment about our newest member of the show for Kira. She'd love it. So let her have a warm welcome. Again, we always thank you for watching. Keep tuned for next week. Keep tuned.
Tune in.
Tune in to next week. We love you all. As always, lead with love and it's going to be okay. See you guys.